Tonight, we are going to have an important conversation. A conversation that affects your wallet, your retirement savings, the price you pay at the pump, and frankly, the economic future of this country. We are talking about the growing military conflict involving Iran and what it could mean, what it will mean for financial markets, and for gas prices right here at home. Now, I know what some of you might be thinking. Another conflict in the Middle East. We have seen this before. We have been through this before. And you are right, we have. But here is the thing. This time, the stakes are different. The global economy is different, and America's position in the energy landscape has shifted in ways that most people do not fully understand yet. So tonight, I am going to break all of it down for you. No spin, no speculation, just the facts, the analysis, and what you need to know to protect yourself and your family financially. Let us start with the basics. Iran is not just another country in the Middle East. Iran is one of the most important energy producers on the planet. It is a member of OPEC. It produces roughly 3 to 3.5 million barrels of oil per day. And more importantly, Iran sits along one of the most critical shipping lanes in the world, the Strait of Hormuz. Now, if you are not familiar with the Strait of Hormuz, let me put this into perspective for you. Roughly 20% of the world's oil supply passes through that narrow waterway every single day. 20%. That is about 20 million barrels of crude oil flowing through a chokepoint that is only 21 miles wide at its narrowest point. So when we talk about a war involving Iran, we are not just talking about a regional conflict. We are talking about a direct threat to the global oil supply chain. And when you threaten the oil supply chain, you threaten everything. You threaten the price of gasoline. You threaten the cost of goods. You threaten inflation. You threaten the stock market. You threaten the bond market. You threaten the United States dollar. Everything is connected. Let us talk about gas prices first, because that is what most Americans feel immediately. Right now, the national average for a gallon of regular unleaded gasoline sits in a range that most families would describe as manageable, but certainly not cheap. We have come down from the historic highs we saw in recent years, but we are nowhere near the $2 a gallon prices that many Americans remember, and frankly, that many Americans expect. Now, here is where things get serious. If a full-scale military conflict with Iran disrupts oil production, or, more critically, if Iran makes good on its long-standing threat to close or mine the Strait of Hormuz, we could see oil prices spike to levels we have not seen in over a decade. Energy analysts across Wall Street and in Washington have modeled various scenarios. In a limited conflict, targeted strikes, contained military operations, no disruption to shipping lanes, we could see oil prices jump $10 to $15 per barrel relatively quickly. That translates to roughly a 25 to 40 cent increase per gallon at the pump for American consumers. That is noticeable. That is painful for a lot of families. But it is manageable. However, in a worst-case scenario, a prolonged conflict, disruption of the Strait of Hormuz, attacks on Saudi or Emirati oil infrastructure by Iranian proxies, damage to refining capacity in the Gulf, we are looking at a completely different picture. Oil could surge to $150, even $170 per barrel. At those levels, you are looking at gas prices of $5, $6, possibly $7 a gallon in parts of the country. And that kind of spike does not just hurt at the pump, it ripples through the entire economy. And that brings us to inflation. America, let me be real with you. We have spent the last 2.5 years fighting an inflation battle that has been the most painful economic experience for everyday Americans in 40 years. We watched grocery prices climb 30–40%. We watched housing costs go through the roof. We watched the Federal Reserve raise interest rates at the fastest pace in modern history to try to bring inflation under control. And it has been working. Slowly, painfully, but it has been working. A war with Iran threatens to undo all of that progress. Here is why. Energy prices are embedded in everything. When oil prices rise, the cost of transporting goods rises. When the cost of transporting goods rises, the price of those goods on the shelf at your local grocery store rises. When diesel prices spike, farmers pay more to run their equipment. That cost gets passed on to food prices. When jet fuel prices spike, airline tickets go up. When natural gas prices rise, and they will rise in a conflict scenario because Iran is also a major natural gas producer, heating costs go up. Electricity costs go up. Manufacturing costs go up. This is what economists call a supply-side inflationary shock, and it is one of the most dangerous types of inflation because it is not caused by too much consumer demand. It is caused by a reduction in supply. And the Federal Reserve's primary tool for fighting inflation, raising interest rates, is far less effective against supply-side shocks. You cannot raise interest rates to create more oil. You cannot raise interest rates to reopen the Strait of Hormuz. You cannot raise interest rates to repair a bombed refinery. So the Fed would be put in an impossible position. Raise rates further to combat rising inflation, which would crush an already stressed consumer and potentially trigger a recession. Or hold rates steady and watch inflation climb back toward levels that erode the purchasing power of every American family. It is a lose-lose scenario, and it is one that keeps policymakers in Washington up at night. Now let us turn to the financial markets, because this is where things get really interesting. Wall Street does not like uncertainty. I will say that again because it is the single most important principle in understanding how markets react to geopolitical events. Wall Street does not like uncertainty, and a war with Iran introduces massive, unprecedented uncertainty into the global financial system. In the immediate aftermath of a military escalation, you would likely see a sharp sell-off in equities. The S&P 500, the Dow Jones Industrial Average, the Nasdaq, all of them would take a hit. History tells us this. We saw it after the Iraqi invasion of Kuwait in 1990. We saw it in the days following September 11, 2001. We saw smaller versions of it when tensions with Iran flared in 2019 and 2020. Markets sell first and ask questions later. But here is the nuance. Not all sectors of the market would be affected equally. Energy stocks, the Exxons, the Chevrons, the ConocoPhillips of the world, would likely surge. When oil prices go up, oil company profits go up. Their stock prices follow. Defense stocks, Lockheed Martin, Raytheon, Northrop Grumman, General Dynamics, would also likely see significant gains. War means defense contracts. Defense contracts mean revenue. Revenue means higher stock prices. On the other hand, sectors that are highly sensitive to energy costs would suffer. Airlines, shipping companies, retail, consumer discretionary, these sectors would take a beating. Companies with thin margins that rely on affordable transportation and logistics would see their profitability squeezed, and that means their stock prices would fall. The bond market would also react dramatically. In times of geopolitical crisis, investors flee to safety, and the safest asset in the world is still the United States Treasury bond. You would see a massive flight to quality. Treasury yields would initially drop as bond prices rise from the surge in demand. But here is the complication. If the conflict drives inflation higher, then the longer-term trajectory for bond yields would actually be upward, because investors demand higher yields to compensate for the erosion of purchasing power that comes with inflation. So you would have this tug-of-war in the bond market between the safety trade pulling yields down and the inflation trade pushing yields up. It would be volatile, it would be confusing, and it would make an already complex interest rate environment even more challenging for the Federal Reserve. Let us also talk about the dollar. The United States dollar is the world's reserve currency. Oil is priced in dollars. In the short term, a conflict with Iran would likely strengthen the dollar as global investors seek safe haven assets. A stronger dollar has mixed effects. It makes imports cheaper for American consumers, which could help offset some of the inflationary pressure from rising energy costs. But it also makes American exports more expensive for foreign buyers, which hurts American manufacturers and farmers who sell goods overseas. And a stronger dollar can put pressure on emerging market economies that have borrowed heavily in dollar-denominated debt, which can create secondary financial crises in other parts of the world. And in a globally connected economy, financial crises abroad have a way of coming home. Now, I want to address something that a lot of people bring up when we talk about energy security in the Middle East. Some people say, well, America is now the world's largest oil producer. We produce more oil than Saudi Arabia. We produce more oil than Russia. So why should we care what happens in the Strait of Hormuz? Why should we care about Iranian oil production? It is a fair question, and here is the honest answer. Oil is a globally traded commodity. Its price is set on the global market. Even though the United States produces an enormous amount of oil domestically, we are still connected to the global price. If the global supply of oil drops by 5 million barrels per day because of a conflict in the Middle East, the price of oil goes up everywhere, including here. American oil producers cannot simply flip a switch and increase production to make up for the shortfall. Ramping up production takes time. It takes investment. It takes workers. It takes infrastructure. And even if we could ramp up production quickly, the refining capacity in this country is constrained. We have not built a major new refinery in the United States in decades. So even if we have the crude oil, we may not be able to refine it into gasoline fast enough to meet demand and keep prices stable. That is the reality. Energy independence is a worthy goal, and we have made incredible progress toward it. But energy independence does not mean energy isolation. As long as oil is priced on a global market, events in the Persian Gulf affect prices in Peoria, in Pittsburgh, in Phoenix, and everywhere in between. Let me also talk about the secondary economic effects that often get overlooked. A war with Iran would likely disrupt global supply chains in ways that go beyond oil. Iran has proxy forces across the Middle East, in Iraq, in Syria, in Lebanon, in Yemen. A broader conflict could destabilize shipping routes in the Red Sea, which we have already seen with Houthi attacks on commercial vessels. It could disrupt trade through the Suez Canal. It could create refugee crises that affect European economies, which are major trading partners of the United States. The global insurance industry would also be affected. Shipping insurance premiums in the Persian Gulf and the Red Sea would skyrocket. Those costs get passed on to consumers. Every container of goods that passes through those regions would become more expensive to ship. And that means higher prices on everything from electronics to clothing to automobiles. There is also the question of consumer and business confidence. Wars create fear. Fear creates uncertainty. Uncertainty causes consumers to pull back on spending and businesses to delay investment. That pullback in economic activity can become a self-fulfilling prophecy. If enough consumers stop spending and enough businesses stop investing, you get an economic slowdown. Combine that with rising inflation from energy prices, and you get the worst of both worlds, what economists call stagflation. Low growth and high inflation at the same time. We experienced it in the 1970s during the oil embargo. It was one of the most painful economic periods in modern American history. And the conditions for a repeat are more present today than many economists want to admit. So what should you do? What should ordinary Americans be thinking about right now? First, do not panic. That is always the first rule. Markets are resilient. The American economy is resilient. We have weathered wars, recessions, financial crises, and pandemics. We will weather this too, if it comes to that. But being prepared is not the same as panicking. Being prepared is smart. Second, pay attention to your investment portfolio. If you are heavily concentrated in sectors that are vulnerable to rising energy costs, airlines, hospitality, retail, it may be worth having a conversation with your financial advisor about diversification. Energy stocks, defense stocks, and commodities can serve as hedges in a conflict scenario. Third, think about your personal energy costs. If you have the ability to lock in fixed-rate contracts for heating oil or natural gas, it may be worth considering. If you have been putting off buying a more fuel-efficient vehicle, the calculus might be changing. Fourth, build up your emergency fund. In times of economic uncertainty, having 3 to 6 months of living expenses in liquid savings is more important than ever. If inflation spikes and the economy slows, having that financial cushion could be the difference between weathering the storm and going into debt. And fifth, stay informed. Do not rely on social media hot takes or sensational headlines. Follow credible sources. Understand the nuances. The situation with Iran is complex, it is evolving, and the economic implications depend on a range of variables that can change rapidly. Let me close with this thought. America has always been at its best when we face challenges with clear eyes, steady hands, and an informed citizenry. The potential for a conflict with Iran is serious. The economic implications are real, but they are not insurmountable. We have the strongest economy in the world. We have the deepest financial markets in the world. We have the most innovative energy sector in the world. And we have the most resilient people in the world. But resilience is not the same as complacency. We need to be honest about the risks. We need to be clear-eyed about the potential costs. And we need to be prepared, as a nation and as individuals, for the economic turbulence that a conflict with Iran could bring. The price of gas, the rate of inflation, the value of your retirement account, these are not abstract numbers on a screen. They are the substance of everyday American life, and they deserve our full attention. Stay sharp, America. Stay informed, and stay prepared. I will see you right back here next time.